Picture this. You finally decide to become responsible with money. You stop wasting cash on random things that disappear from your life within days. You begin saving every month and watching your bank balance slowly grow like proof that your future is becoming safer. At first it feels amazing. Every transfer into your savings account feels like progress. Every extra dollar sitting there gives you a sense of control that most people never experience. But then something strange happens. One night you open your banking app and stare at the numbers for longer than usual. You realize your money has been sitting there for years, barely moving, barely growing, almost frozen in place. You start doing the math. $10,000, earning almost nothing. $20,000, losing value quietly because inflation keeps rising faster than your interest rate. Suddenly, the thing that once felt safe begins to feel dangerous in a different way. That is the moment many people experience a financial awakening. They realize saving money is important, but saving alone rarely creates freedom. Saving protects you from emergencies, but investing builds the life you actually dream about. And this is where fear enters the conversation. Because saving feels calm, while investing feels uncertain. A savings account never drops 20% overnight. A stock market investment absolutely can. Most people stay stuck here for years. They keep saving, but never invest, because the jump from safety to growth feels emotionally terrifying. They know they should invest, but they never feel fully ready. The truth is simple. Almost nobody feels ready in the beginning. Every investor you admire once stared at their first investment with nervous hands and a racing mind, wondering if they were making a huge mistake. This story is not really about money. It is about transformation. It is about learning how to stop treating money like something you only protect and start treating it like something that can work for you. Because there are two completely different financial lives people live. The first person works for money forever. The second person slowly builds systems where money starts working for them. And the gap between those two lives becomes enormous over time. Not in 1 year, not in 5 years, but over decades, the difference becomes life-changing. Imagine two friends named Daniel and Ryan. Both are 25 years old. Both earn the same salary. Both want financial freedom someday. Daniel believes saving is enough. Every month, he places money into a basic savings account because it feels safe and predictable. Ryan also saves money, but after building an emergency fund, he begins investing small amounts into low-cost index funds. At first, their lives look almost identical. Both are disciplined. Both avoid unnecessary spending. Both feel responsible with money. But time changes everything. After 10 years, Daniel has built a decent savings balance that barely grew beyond his contributions. Ryan, meanwhile, has experienced market crashes, scary headlines, and uncomfortable volatility, but his investments have quietly compounded in the background. After 20 years, the gap becomes shocking. Daniel still depends almost entirely on his job for financial progress. Ryan now owns assets that generate growth while he sleeps. This is the hidden power most people never fully understand. Wealth is not built only by effort. Wealth is built when effort and time combine with compounding. Compounding looks boring in the beginning. That is why so many people underestimate it. In the first few years, the growth feels slow and unimpressive. Then something magical happens. The growth begins accelerating because your money starts generating returns, and those returns begin generating their own returns. It becomes a snowball rolling downhill, getting larger without requiring equal effort. But psychologically, this is difficult for beginners to accept. Human beings naturally value immediate certainty over long-term growth. We prefer seeing guaranteed small results today instead of uncertain larger results tomorrow. That is why investing feels emotionally uncomfortable at first. Your brain interprets market volatility as danger, even when long-term history shows consistent growth over decades. Now, let us make something very clear. Investing is not gambling when done properly. Gambling depends on luck and short-term outcomes, while investing depends on ownership, patience, and long-term economic growth. The problem is, many beginners enter investing the wrong way. They chase hype instead of learning fundamentals. They try getting rich quickly instead of getting wealthy slowly. That is where disaster happens. People buy random stocks because social media told them to. They jump into risky cryptocurrencies without understanding what they own. They trade emotionally based on fear and excitement. Then when losses come, they panic and quit entirely. Not because investing failed, but because they approached it without a system. Emotion replaced discipline. Real investing looks much less exciting than social media makes it appear. It often looks boring. Small, consistent contributions. Long holding periods. Quiet patience. But boring is powerful. Boring built most real wealth in the world. The people who quietly invested every month for 30 years often outperformed the people constantly chasing the next exciting opportunity. Think about a tree for a moment. The strongest trees do not grow overnight. They grow slowly with deep roots that survive storms most smaller plants cannot survive. Investing works the same way. A portfolio built steadily over decades becomes strong because time strengthens it. Sudden wealth often disappears quickly, while patient wealth tends to last. Now imagine you are standing at the beginning of this journey. You have money saved, but fear keeps stopping you from investing. What should you actually do first? The first step is building a real emergency fund. This matters more than most people realize. Before investing heavily, you need enough cash saved to survive unexpected problems without touching your investments. 3 to 6 months of living expenses is a good target for most people. This money is not investment money. It is stability money. Your emergency fund protects you emotionally during market downturns. Without it, you may panic and sell investments during bad times because you suddenly need cash for life emergencies. Most panic selling happens because people invested money they could not emotionally or financially afford to leave alone. The emergency fund creates breathing room and patience. Once that foundation exists, you can mentally separate money into 2 categories: safety money and growth money. Safety money protects your life, while growth money builds your future. This mental shift changes everything. Many beginners treat all money the same, which makes investing feel terrifying because every market movement feels personal. But when you separate the purpose of money, investing becomes easier emotionally. Your emergency fund handles short-term safety, while investments handle long-term growth. Then comes the next important lesson. Start small. Do not wait until you have huge amounts of money before learning how to invest. People waste years believing investing only matters once they become rich. In reality, investing is often how people become rich slowly over time. Even $50 or $100 per month matters because the habit matters more than the amount in the beginning. Small, consistent investing teaches emotional discipline. And emotional discipline is everything in investing. Knowledge matters, but behavior matters more. Many intelligent people fail financially because emotions control their decisions. They buy when excitement is high and prices are expensive. They sell when fear is high and prices are low. Emotion turns investing upside down. That is why automation becomes powerful. Automatic monthly investing removes constant emotional decision-making. You invest consistently, whether headlines are scary or optimistic. This is how many successful investors build wealth quietly. They stop treating investing like entertainment and start treating it like a long-term system. Now, let us talk about simplicity, because beginners often overcomplicate investing. They think successful investing requires predicting markets or constantly analyzing individual companies. For most people, the simplest strategy is often the strongest. Low-cost index funds have consistently outperformed many professional investors over long periods. An index fund allows you to own hundreds of companies at once. Instead of betting everything on one business, you own pieces of entire markets. This creates diversification, which reduces risk dramatically. One company can fail. Entire economies across decades tend to grow. That is why index investing became so respected. It accepts a powerful truth. Predicting short-term winners consistently is extremely difficult, even for professionals. So instead of trying to outsmart markets, index investors focus on participating in overall economic growth. Simple, consistent, effective. Now here comes the part most people struggle with emotionally. Market crashes. Every beginner fears them. The news makes crashes sound like the end of the world. Red numbers appear everywhere. Panic spreads quickly. People begin believing disaster will last forever. But historically, markets recover because businesses continue innovating, economies continue growing, and human progress continues moving forward over long periods. Experienced investors understand something beginners often miss. Market crashes are normal. They are uncomfortable, but they are part of the process. In fact, crashes can become opportunities for disciplined investors. When prices fall, your monthly contributions buy more shares at lower prices. This feels emotionally backward because human psychology wants to run away during fear. But long-term investing often rewards calm behavior during uncertain periods. Think about how people shop normally. When clothes or electronics go on sale, people become excited to buy cheaper prices. Yet when investments go on sale, many people panic instead. This happens because emotion clouds logic when money feels threatened. That is why discipline matters more than intelligence in investing. The investors who usually succeed are not always the smartest. Often, they are simply the ones who stayed consistent long enough for compounding to work. Now let us talk about time, because time changes everything financially. A person who starts investing at 25 has a massive advantage over someone starting at 40. Not necessarily because they invest more money, but because they give compounding more years to operate. Time becomes a hidden multiplier. This is why starting imperfectly now often beats waiting for perfect conditions later. Perfect timing rarely exists. Many people delay investing because they want certainty. They want guarantees the market will rise immediately after they invest. But markets never offer certainty. Waiting forever for perfect timing usually becomes the most expensive mistake. Years pass, while money sits idle, losing purchasing power quietly. The earlier you begin learning and investing responsibly, the more opportunities time gives you. Time rewards patience more generously than almost anything else in finance. Now imagine two versions of your future self. One version continues only saving money for the next 20 years. The other version saves responsibly while consistently investing for growth. The second version likely experiences more emotional discomfort along the way. Market downturns, uncertainty, volatility. But the second version also experiences something powerful later in life: financial flexibility, options, freedom. Because eventually, there comes a moment where investments begin carrying real weight. Dividend payments appear. Portfolio growth accelerates. Passive growth starts supplementing earned income. And suddenly, work becomes less about survival and more about choice. That is the hidden goal most people are actually chasing, even if they do not realize it. Financial freedom is rarely about luxury first. It is about reducing fear, reducing dependence, reducing the feeling that one emergency could destroy your life. Investing responsibly over long periods slowly builds that freedom. Not overnight, not through shortcuts, through consistency. Now let us address another important truth. Your income matters, but your habits matter more over time. Many high earners stay broke because spending rises with income. Meanwhile, some moderate earners quietly become wealthy through disciplined investing and controlled lifestyles. Wealth is often less visible than people think. Many wealthy people do not look wealthy because real wealth usually lives in assets, not appearances. Cars depreciate. Designer items lose value. Social status purchases disappear quickly. Investments, however, can continue growing for decades. That does not mean never enjoying life. It means understanding the difference between temporary pleasure and long-term freedom. Every dollar has potential energy. You can spend it today for a short experience, or invest it for future opportunities. Neither choice is automatically wrong, but understanding the trade-off changes how you see money. Now here is something important nobody talks about enough. Investing also changes your mindset. When you begin investing consistently, you stop seeing yourself only as a worker. You begin seeing yourself as an owner of businesses, an owner of assets, an owner of future growth. That shift affects confidence deeply. Your relationship with money becomes less emotional and more strategic. You stop chasing quick fixes and start building systems. And systems matter because motivation fades. Motivation feels strong after watching an inspiring financial video. But real wealth building depends on habits continuing long after excitement disappears. Automatic investing, consistent saving, long-term patience. These boring habits quietly outperform emotional decision-making over decades. Now maybe you still feel nervous about investing. That is normal. Fear does not disappear instantly. The goal is not eliminating fear completely. The goal is learning how to act responsibly, despite uncertainty. Every meaningful part of life contains uncertainty. Careers, relationships, businesses, health. Nothing important comes with absolute guarantees. Investing responsibly is simply accepting calculated uncertainty in exchange for long-term growth potential. Avoiding all uncertainty often creates hidden risks of its own, because inflation quietly destroys idle cash over time. Prices rise while stagnant money loses purchasing power year after year. That means doing nothing also carries consequences. Safe does not always mean harmless. This is why financial education matters so much. Understanding basic investing principles removes unnecessary fear and replaces confusion with clarity. You do not need to become a financial genius overnight. You simply need enough understanding to make thoughtful long-term decisions consistently. Read books, learn slowly, ask questions, study history, focus less on hype and more on timeless principles. Most successful investing advice is surprisingly repetitive because the fundamentals rarely change. Spend less than you earn. Save consistently. Invest regularly. Diversify wisely. Stay patient. Simple does not mean easy emotionally, but simple works. Now imagine yourself 20 years from today. Imagine opening your investment account after decades of consistency. Imagine seeing growth created not only by your hard work, but by time itself. That future version of you will probably wish you started earlier. Almost every investor feels that way eventually. Very few people regret investing responsibly for their future. Many regret waiting too long because fear kept controlling their decisions. And that brings us to the most important truth in this entire conversation. Saving money creates stability, but investing creates possibility. Saving protects you from disaster. Investing creates opportunity. You need both. The goal is not choosing between saving and investing. The goal is learning when each one matters most. Early on you save for safety. Then gradually you invest for growth. Over time, the balance between protection and opportunity becomes the foundation of financial freedom. Because money should not only sit still protecting you from life. Eventually, it should begin building the future you actually want to live. And remember this, you do not need to become rich overnight. You do not need perfect timing. You do not need advanced financial knowledge before taking the first responsible step. You simply need consistency, patience, discipline, and the courage to stop letting fear make every financial decision for you. The moment you transition from only saving to responsibly investing, something powerful changes. Your money stops sitting quietly on the sidelines and finally starts working beside you. That is when financial growth truly begins.